In this recording, we're going to look at the big picture for accounts receivable. Accounts receivable goes up with debits and of course down with credits, and we're going to talk about it also have this allowance account connected to it. So let's kind of go over the big picture. Usually there is a beginning balance in accounts receivable, so some dollar amount, and then we kind of I want you to think back what actually creates accounts receivable, what causes it to go up. Well, selling on account or credit sales cause it to go up. So when we have sales, particularly sales on account, or I'll call it credit sales, it causes it to go up. And if we do sell on account or have credit sales, there's only two possibilities of what's going to happen in the future. So, either we're going to collect our cash from customers, and that will cause our accounts receivable to go down, or we won't collect our cash from customers, and if we don't collect, eventually we will just write off those customers. So write-offs also cause it to go down. So in the big picture, selling on account creates accounts receivable, and either we will collect that money or we won't, and we'll write off customer accounts. So, we net our debits minus our credits, and essentially then we get our ending balances. Here. The allowance account reports the dollar amount of accounts that we do not expect to collect. And so we know, reasonably speaking, if we're going to sell on account, we know it's likely we won't collect all of that. So as we go along, we're going to have an estimate. So the allowance for doubtful accounts is actually an estimate of what we won't collect. So again, it's just an estimate. So again, we will have a beginning balance. So of this beginning balance here, here's the dollar amount that we anticipate we will not collect. Now it's going to go up for our estimates, but what causes it to go down are when we have actual bad accounts that we write off. So it will go up for what we estimate, and it will go down for actual accounts that we write off. So write-offs not only reduce accounts receivable, but write-offs also reduce the allowance for doubtful accounts. Okay, so we have our beginning balance and then our write-offs for actual bad customers that we know we are not going to collect. So here's what we estimate. When we know particular customers that are not going to pay us back, then we write them off. Okay, and then that will give us an unadjusted balance at the end of the accounting period. An unadjusted balance. I'm just going to abbreviate a balance, BAL. And it can be either a debit or a credit balance. If it's a debit balance, that's because we wrote off more customers than we estimated. So we would have underestimated then. If we have a credit balance, it's because our estimate exceeded actual bad customers that we wrote off. So we would have overestimated if it's a credit balance. At the end of the accounting period then, we're going to look at our accounts receivable balance, and we will estimate, how much of that we're not going to collect. So we're going to have an ending balance based on this number. How much of that do we anticipate we will not collect? And so again, this is going to be an estimated number because obviously we don't know actual customers that aren't going to pay. If we knew that, we would never have sold them on account to begin with. Okay, so we will have at the end of the accounting period, we'll make an adjusting journal entry, right? Adjusting journal entries are made at the end of the accounting period for bad debt expense. So we will debit bad debt expense. Just going to abbreviate expense, EXP. So we will debit bad debt expense, credit the allowance account for the estimated amount. Okay, so what are we going to see on the balance sheet? We'll see these two ending balances. So we'll have ending accounts receivable, ending allowance for doubtful accounts, and the difference, the accounts receivable minus its related allowance account, gives us a number called net realizable value. In accounting, the word realize means cash. So net cash value. This is what we really expect to collect from customers. So you can see then why the FASB, the Financial Accounting Standards Board, is insistent that we report accounts receivable at the dollar amount of cash we really anticipate collecting, not the gross amount. Okay, and then on the income statement, we're matching sales with the bad debt expense, and again, this is going to be an estimate. So we have an estimated bad debt expense on the income statement. The allowance for doubtful accounts is also an estimated amount on the balance sheet. Okay, and then on the income statement, sales revenue and bad debt expense, those two get matched in the same accounting period. So of this sales revenue, here's our estimate of the dollar amount we think that we will not collect. I couldn't actually find an exercise or problem at the end of Chapter 7 that walked all the way through accounts receivable, so I just created my own. So let's look at this demonstration problem. Now you're going to have homework in Wiley Plus, but it will kind of take a snippet. It'll do maybe, part of something of accounts receivable, and there'll be another exercise or problem that'll do another aspect of accounts receivable. So this demonstration problem will help you with all of the assignments in Wiley Plus related to accounts receivable. So let's read through it. At the end of the month of April, but before preparing its financial statements, the Mix Company was notified by the attorney of one of its customers that the customer had filed for bankruptcy in April and would not pay its $600 of bills. The accountant realized that no provision had been made for such eventualities, and you were asked to assist the accountant in recording bad debts expense using the aging of receivables method calculated from this aging schedule presented below. And we have credit sales of $65,000 were made during the month of April. So what's happening here is that if we add up all of these accounts, so our accounts receivable, if we add all of this up, we're going to get an ending balance of $40,000. And so here's accounts receivable and the allowance account, and here's its ending balance of $40,000. And if we age these accounts, so if we pull out the dollar amount of accounts that are 1 to 30 days old, those are 31 to 60 days, 61 to 90, and over 90 days, and schedule those $40,000 out, it would look like this for the Mix Company. Now we're going to estimate of those that are still current, what percentage of those will go bad. And it's going to be a small percentage because, if they're not very old, we would anticipate at that time being able to collect most of those. But notice when we get to over 90 days, Mix anticipates, because they're so old, it's likely customers are not going to pay. So, we're just going to kind of schedule out and put equal signs here. So 26,000 times 1%, we anticipate we won't collect 260 of those. 450 of the next layer, 600 of the third layer, and of those over 90 days old, 690. So we're anticipating, if I add all of this up, that of the $40,000 of accounts receivable, Mix, based on their aging of accounts receivable, anticipates that, I'm going to put it in here because I had a question mark there, that $2,000 of that will go uncollected. So that's their estimate for the allowance for doubtful accounts. They're anticipating $2,000 will go uncollected. So what they want us to do, make journal entries on the next page and show the effect on the balance sheet and income statement. So let's go look at what we've got. Okay, so if we go back, we know the beginning balance of accounts receivable was $24,000. And we know that sales caused it to go up, and I'm just going to put a number 1 there. Sales were $65,000, so actually I'm posting it, but let's go down here. when we have sales on account, we would debit accounts receivable, right, to cause the asset to go up, and sales gets credited, causing it to go up. And I've just taken that debit and put it in the accounts receivable. So I kind of did that backwards, didn't I? Okay, and then they also tell us, let's see, how much was collected. And so we also want to look to see how much was actually collected. Well, this little problem is a little tricky. Let's go ahead and look at, we know the ending balance in accounts receivable is going to be $40,000. And we also know that there is going to be, we have $600 that we actually are going to write off. Went the wrong way with that. So this is done a little bit sort of out of sequence because the write-off, remember write-offs reduce both the allowance account and accounts receivable. So the allowance account goes down, accounts receivable goes down. So let's post that, $600, make that number 2. And 2. So we have our debit to the allowance account, posting that, our credit to accounts receivable, posting that. Now, this particular problem is a little bit of a puzzle because we know if we sell on account, either we don't collect our money or we do collect our money. So this actually has you just look at the account, and I have to numerically, figure out how much was collected in cash. So 24,000 plus 65,000 minus 600, minus X equals 40,000. So if I solve for what is this one unknown, it's going to be 48,400. So 24 plus 65 minus these two together, that's 49,000, and I'll get 40 grand as an ending. So again, this plus that, and if I subtract these two credits, I'll end up with 40,000. So by default, I figure out, they must have collected 48,400 in cash during this accounting period. So cash goes up, accounts receivable goes down. And normally, you're going to know the amount of cash collected. This little case just kind of threw this in and made it a little bit of a puzzle. So normally that would be given to you without you having to solve for it through the T account. Okay, so here we are. It told us there was no beginning balance in the allowance account. So we're at the end of the accounting period. We have recorded credit sales, cash collections, and write-offs. So at the end of the accounting period, we're going to have an unadjusted balance of a debit in the allowance account. They had estimated 0 at the beginning of the period. They wrote off 600, so they have underestimated by $600. Now, the normal balance in this account is a credit, and we've already figured out of this 40,000, of that 40,000, we estimated 2,000 will be uncollected. So we want the balance to be $2,000 here. So in order to get that to be $2,000, I need an adjusting journal entry for $2,600, and that's going to be our estimate for bad debt expense. Here is our adjusting journal entry, right? It's going to be an adjusting journal entry at the end of the accounting period for bad debt expense, right? A debit, a minus 600 plus 2,600 is a balance of 2,000. So we estimate $2,600 of bad debt expense. Okay, well, let's look at all these journal entries. We have sales of $65,000. That'll go on the income statement, reported on the income statement. We have bad debt expense of $2,600. So those will be matched together, right, in the same accounting period. We want to match revenue with its related expense. We also will have ending balances for accounts receivable and the allowance account. So accounts receivable has a balance of $40,000. The allowance account, the allowance for doubtful accounts, has a balance of $2,000. So we have a debit minus a credit. So the dollar amount the company actually expects to collect is $30,000. So we have what we report on the income statement, and here's what we would report on the balance sheet. Okay, so we can see we've gone through the first part, required, and what's the effect on the income statement and balance sheet. Now, here's some particular things. The write-off of $600, when we know there's a particular customer that's not going to pay, what is the impact on the financial statements? So let's look at that closer. So we're going to look a little bit closer at this $600 item. So let's go to our next page and let's just kind of review what we had. We had a beginning balance of $24,000. We had sales, credit sales of $65,000. And then there was cash collected of $48,400. And so before the write-off, if I exclude the write-off, the balance in accounts receivable would be $40,600. So I've just made the same transactions and posted the impact of the beginning balance, credit sales, and cash collections that I had over here. The $24,000, the $65,000, and the $48,400. Now I want to look at when we wrote off the $600, what difference does it make? So let's look at that. And also, by the way, remember there was a zero beginning balance in the allowance for doubtful accounts. So we would have this beginning balance, and here's the balance before the write-off. The write-off reduces both accounts. So we debit, when we have a write-off, we debit the allowance account, credit accounts receivable. And so after the write-off, we have this $600 debit, and then $40,600 minus $600, we have a $40,000 balance. Okay, well, let's talk about net realizable value. Before the write-off, the net realizable value, which is accounts receivable less the allowance to get the net realizable value, so $40,600 minus 0 gave us a net realizable value of $40,600. After the write-off, let's look at it. We have two debits, so now I'm going to actually add them together, and I have a balance of $40,600. So there is no change in net realizable value. So if there's no change in net realizable value, there's no change in total assets. So there's not much of a difference. The only difference is in the details. Now we report, instead of $40,600 of accounts receivable, we're reporting $40,000 because $40,000 is what we're going to make. We will continue to make efforts to collect the $40,000. We're not going to keep trying to collect that $600 up above. Okay, the other interesting thing, so that's for the balance sheet. So no major impact on the balance sheet. Doesn't change net realizable value, doesn't change total assets. The other thing is, notice the write-off only impacts these two accounts. So there is no impact on net income. It had nothing to do with net income. Yep, I left out my N. So there's no impact on net income, right? We didn't have an entry for bad debt expense. So the write-off really doesn't do a whole lot other than it's affirming that we are giving up our efforts to collect that $600. What I do want to make a comment, though, is bad debt expense. It's when we make this journal entry for this estimated amount that has an impact. Because here we're creating bad debt expense. that will decrease net income, right? So in this case, we decrease net income, so it has that impact on the income statement. And on the balance sheet, if we credit the allowance account, that's going to reduce total assets. Credits reduce total assets. So it'll reduce net realizable value. So total assets will go down and net realizable value will go down. So let me kind of draw a divider there. So it's this estimated journal entry for the estimated amount at the end of the accounting period has an impact, a major impact on the income statement and the balance sheet. Okay, last item. So we've looked at writing off customers. But once in a great while, we may have a customer that comes back and actually makes payment. So what about if this customer that we wrote off for $600, what if 2 years later they come back and pay us $100? Now, I fast forwarded, so, here was number 1, here's subsequent collection. So I just made this numbers up, but let's say 2 years down the road, at that time, our balance is $50,000 and $30,000. So, what if that would be our balances? So, what will happen if a customer comes back? Step 1, I'm going to put 1A for a journal entry. We will put their balance back in accounts receivable and back in the allowance account. So we re-establish the customer. I debit accounts receivable, credit the allowance account. And then the second part, I'll do as 1B, is we record the cash coming in. We debit cash, credit accounts receivable. So step 2 is, it's like any collection. Cash comes in, we credit accounts receivable. So if they do come back, we can make 2 things that we do. Reestablish their account, record the cash coming in. Now, I'm going to abbreviate that, so I could do it in 2 parts. Whoop. So I could take 2 steps, 1A and 1B, or I could do it in 1 step. And if I do it in 1 step, it's because I recognize there's both a debit and a credit here. So I'm really just going to focus on, because those cancel each other out, if I do it that way, I'm really just debiting cash $100, and I credit the allowance account $100. But this one's usually a little more difficult to when I see a debit to cash and a credit to the allowance account, that doesn't seem accurate. So that's a little more difficult to understand. It's a little bit easier to understand it in the 2-step process. Okay, so there we have the big overview of accounts receivable.